Right now, there is a focus globally and certainly from individual and institutional investors on a number of things, a high list of uncertainty. Today, we're talking about Brexit, which actually seems to be the least thing phasing, certainly the U.S. markets. I think certainly up there are, how sensitive this Fed is going to continue to be to the market. That sensitivity is sort of an interesting thing to talk about as we sit here in the midst of a government shutdown, having less data coming forward every day and every month. But I think, the way that people are paying attention not only to JPAL, but to all of the state-level directors and the rhetoric coming out is really something that, that we've not seen before.
I saw somewhere, I read so many things before the show, but worst market reaction to a Fed hike since 1994 or something.
And I actually remember 1994.
Yeah, I remember. I think all of us.
Florida, February, and it was nasty. I remember that. So.
But not, yesterday we had Ed Lazier on, and he was saying that the stock market always anticipates better than anything else, whether the economy's slowing or not. And I just made the point that, the market went up based on an easy Fed. Now it's going down when the Fed tries to remove liquidity. I'm not sure that it's necessarily forecasting anything. It just seems like traders sometimes they just sell based on rates going up because they don't like the punch bowl ever being taken away.
I think that's correct. And you've got obviously the advent now of algorithmic trading,
all that stuff,
and high frequency trading, which are trading off of news blips.
What's a Fed to do then? Is a Fed just supposed to, every time there's a tantrum, they're supposed to say, okay, sorry, we're going to stay low?
It does seem like things are pretty acute now, right? And we went from what is our Fed going to do in general, how supportive are they going to be through their monetary policy, to what are they going to do with the balance sheet? And we're looking at, real minutiae language at this point. We have had a historic lack of vol over this bull market cycle. And, now we're having $60 billion a month removed from liquidity. And I think that was really globally propping up some of the markets. And with that coming out of the system, I feel like this volatility in this range around 20 is probably going to stay with the VIX.
So even with Powell saying we're not going to do anything immediately, or at least us picking up on that signaling, just continuing to let the balance sheet run off is going to create some chaos anyway?
I think it's going to take away one of the global sources of dampeners for volatility and sort of flux when that happens. But to your point, initially, Joe, the last three rate hike cycles we've seen, we're talking 5% normal rate, we're talking 8% normal rate. And right now we're having a conversation about what the difference between 2.25 and 2.75 means, and the market is focusing really specifically on that. So some of it is, I think, semantics. Some of it is just exactly, it's sort of a knee-jerk reaction to how does the market, how do institutions, how do governments and sovereigns respond to an increasing and tightening cycle. And part of it is that we just have to understand that we're going to give time. The Fed seems to be using the right wording, have the right posturing going forward. Global Feds seem to be supportive of that unanimously. Look, this morning, as I said, we have Brexit, and that seems to be not a problem for the futures. Our markets seem to be focusing more on the 22 earnings announcements we're going to see today and what their prognostications for the new year look like.
There's a headline. EU Commission says Brexit withdrawal agreement is not open for renegotiation. It's March 29th. That's what this. Maybe we can bring these negotiators over here to try and get our government open. Not open for. They won't do it either. So
you would think they're going to have to extend Article 50. I think that's a kind of a given that they're going to have to give themselves more time to figure this out. There was a great op-ed piece over the summer from John Nelson, the former head of Lloyd's of London, who basically said it was more or less, ill-conceived and not prepared well, the entire process for Brexit. So not surprising that this is happening at this juncture.